Good afternoon, everybody. Welcome to RE Journal's Red News webinar series, Breaking Through the Disruption. Hope you like our new intro video. Today We're going to talk about capital markets in Texas mostly, but we'll cover the whole South or the whole country if we need to. We're going to talk investment grade real estate, and we're going to also talk about business loans for small business, owner occupied. So we're going to cover the gamut today. Where are we at with our lending environment right now? Today's webinar brought to you by Seacoast Commerce Bank, Grandbridge Real Estate Capital. Couple housekeeping items. So we are recording all of our webinars, and they're available on our YouTube channel. We're so progressive. So here's the, I'll put this up again, but rejournals.com/video replay will get you to our YouTube channel. This is a big one. If you have connection issues, there is a button at the top of your screen, either on a phone or in your computer. That is a reconnect button. That's the best way. If you see somebody freeze up or your audio freezes up, punch that button, it'll reset your connection. Usually that solves most of our problems. We have a chat function. So in the chat room, I want you to put in your name and your company and your state so you can network with everybody that's here. But this is also where you'll be able to answer questions for our speakers. So when you ask a question, I'll try to flag it. I'll cover all of them at the end, but if I can fit them into the conversation, I will. So please feel free to ask questions while we're on it. We also have a poll section. So when you see a little red light up next to the word polls, that means I put a poll up there. I'll throw a couple of fun things out there for us to interact on. We're going to start today's presentation with Dave Rassmussen from Grandbridge in Minneapolis. Dave created a PowerPoint for us a couple weeks ago when we did this event in another state. And we've asked Dave to come back and present these slides again, because I think it's a good background for us and get us up to speed on where we're at quickly. Dave, are you ready?
Let's go. So thank you for the opportunity to join you guys today. And so Grandbridge, our parent company, is the merger of BB&T and SunTrust. We're now the 6th largest bank in the country. Last year, we did a little over $10 billion in financing out of our 27 offices. So we're mainly a long-term fixed rate lender with Fannie, Freddie, HUD, and Life, but we also raise debt and equity for our clients. So I want to just kind of give you the lay of the land and a recap of kind of how great things were coming out of February and kind of where we are looking at, what we're looking at today. So coming out of the MBA conference, every year we have this conference. In the last few years, it's been in San Diego. And we meet with many of our life insurance companies and agency lenders. And 2019 was a record year. And all we kept hearing was 2020, there was more. And the chief investment officers of the life companies, they have basically two pools of funds that they invest in. They're either investing in corporate bonds or they're investing in commercial mortgages. So about 75% of the money tends to go to mortgages and the remainder goes to the bond guys. So over that 2.5 days, we're meeting on the hour and we crank out 20 meetings or more. So corporate bonds were trading, 50 to 100 basis points over treasuries at the time. And so the running joke has always been the last few years, because it's just been record mortgage amounts every year, that when the mortgage guys run out of money, we'll just grab it from the bond guys. So the comparison I want to make is between my daughter at a younger age and the life company bond guys. So when she was very young, she got into modeling, and she did over 100 photo shoots and several TV commercials. And she was getting about $125 an hour. And this one time, everything went into her 529 plan for school. And so she came to me one time, she said, I'd really like to keep the money this one time for buying some things for school. I said, okay, you can keep the money. So later that day, she calls me and she starts screaming in the phone, "I get to keep the money. I get to keep the money." I said, yeah, that's what we agreed to. "I get to keep the money." I said, "Yeah, why are we going over this?" And she said, "Well, it's turned into a 2-day shoot and we're going to get over $1,000. I said, no, hang on. You can keep the 125, but the rest of it's still going into the 529 plan. I told her she needs to go into sales, which she ultimately did. So where does this lead us? Well, the bond guys finally, corporate spreads blew out, and they've been able to keep the money. So, as an example, McDonald's corporate bonds blew out to 3%. And we had a life company that said, we're going to go buy $100 million of this corporate investment grade liquid bond that we can buy and trade the next day versus doing mortgages. So how would we price an unrated, illiquid commercial mortgage? And so that was more temporary, because then the life company came back and told us within a few days these corporate spreads are starting to come back in, and so things look promising. So we had to get to April, because we were 2-3 weeks into March before it really got serious, and we wanted to make sure that everybody made their payments and see what happened on mortgages and in rent collections. And so the recommendation was, and we still continue to make it, is keep your payments current. And when you're making a request to your lenders, that you understand, like, we service $70 billion. We have 12,000 loans on the books. Can you imagine the number of people that are calling our servicing people? You need to put together a detailed plan, and if you're going to ask for assistance or forbearance, and be able to project cash flow from tenants and from yourself, and provide a personal financial statement and rent rolls. We have all kinds of checklists to help people go through making a formal request. So I had a bank tell me that the regulators came in and started talking to them and said, we want you to keep pumping the money out the door. And so they said, and a one-pager that said, work with your clients. And if you need to turn a couple of months into interest only, go ahead and do it. If you need to do some forbearance and tack it on the end of the loan, go ahead and do it. We're not going to ding the quality of your portfolio to do this. But every lender and every loan is a separate case. So if I was ranking the 4 food groups, I'd tell you multifamily is still first, and student housing and senior housing fall under this broad category, but it's going to be very, very selective and very low loan to value. Industrial is second, in my opinion. They love it. Unfortunately, you can't put out the millions of dollars you can in multifamily at 50 and 80 bucks a foot, but industrial still comes in at a very strong second. In office, what can you say? You're sitting at home. And, we're going to go from 250 as the old standard. It was already dropping square feet per person. And this could be the 9/11 event for office. And it's going to change how we dine and work and interact. Retail, okay? We wanted anti-Amazon destination retail like restaurants, salons, and fitness centers. Now, wait a minute. All those are shut here in Minnesota. And then my lender was telling me he's got a client with 5,000 hotel rooms, and he had 9% occupancy in March. I started in October working with a client that had this retail center. They finally got me the information the first week of March, and I had to call them back because they had a restaurant, salons, and a fitness center. And I told them that there wasn't anybody that was around to finance that. The other thing that we're starting to see is appraisers are starting to put some disclaimers in, talking about what could happen to valuations. And so again, lenders are fielding requests, and I think for new deals, they're getting pushed back, and they have to be right down the fairway. And I think the key phrases here, you need to really document your schedule of real estate owned. You're going to have to talk about cash flows and collections. The phrase used to be, from a lender's perspective, they wanted to hear that the borrower has performed as agreed to. Now, the borrower wants to hear the lender has agreed and has performed as agreed to. So one thing I've already heard is if 5% was the standard for underwriting multifamily, as an example, they were going to start asking maybe for 7 or 10% vacancy just on a temporary basis, just to be conservative, but that could be impacting proceeds. So nobody wanted to be the last one to close. Nobody wanted to be the first one to open. The liability was just too great. Unfortunately, I think this goes a little bit longer than we expect. So we're going to hope for the best, but I think we need to plan for the worst.
All right. Thanks, Dave. Fantastic. Now that we've got almost 200 people online, I want to go in and introduce everybody. I didn't start out that way because it takes, in our new world, it takes everybody a little while to get online. Our first guest today, Greg Young, Senior Vice President, Grandbridge Real Estate Capital. Greg is going to talk about investment grade real estate, lending markets, a little bit about ground up and where deals are at and getting new deals done in this environment. Dave Rassmussen, who you just heard from, Senior Vice President, Grandbridge in Minneapolis. And Dave will talk the same kind of things. And then Jim Wilkie. We were lucky to get Jim in on this at the last minute because a lot of the things that are going on right now with borrowers and lenders are not just on the large investment side, but also on the business side. So if you own a retail center, there might not otherwise be. So Jim's going to hit on the small business, owner-occupied, and SBA opportunities. Guys, let's start with a simple one. Where are interest rates at today?
Deal in four primary categories: the government agencies, the life insurance companies, the CMBS lenders, and the commercial banks. The CMBS is easy. CMBS is currently on the sidelines right now. There's just nobody buying those bonds right now, so they're on the sidelines. But as far as the agencies are in the market. They never left. For low leverage stuff, you're looking at tier 4 stuff trading in the low 3s, up to the higher leverage stuff trading in the low 4s. Life insurance companies, the people in and out of the market changes daily. I'd say about half our correspondents are actively in the market quoting deals. The pricing there ranges between 3.5 and say 4.25, 4.40. The banks never left the market either. The bankers that I've been speaking with recently have been trading stuff 1%. Dave, what would you say to that?
Yeah, I agree with your, because we all see the same pricing internally here at Grandbridge, and that's all good stuff. I'm trying to tell clients, especially in the multifamily sector, that if they can be patient on a refinance or an acquisition loan for multifamily, to really consider a HUD transaction. Today, you can get a 3.25 rate, 35-year amortization, 118 debt service coverage. It's assumable. It's non-recourse. It's a hell of a loan. The process is a little challenging, but it's a wonderful product. From the banking side, I'm doing some transactions. I'm doing some construction perm loans and opportunity zones. And we're tying together 3 years of construction floating rate money. And then we're doing a forward swap to lock in the 7-year perm piece that can be locked at closing. So you get through the construction period and then you flop into the swap and into the perm. And we're looking at that permanent piece, locking it today to fund in 3 years, in about that 3.5 to 3.75 range. So it's really some nice financing available out there from banks.
And in my world, the small stuff, the kind of $1 to $5, $6 million range stuff, a lot of owner user seeing similar. The spreads had been squeezed down before any of this hit to the lowest that I've been doing them, and we're kind of on the B range end of it at Seacoast. Of course, the more A stuff will sometimes be done by the bank still on a more longer term fixed rate, but we're doing prime and 3/4, which I'd never done before. And of course, prime has rode down in the meantime. So in the SBA world, to be doing the more aggressive, quicker stuff at 4% is unheard of in my 25 years of doing this, 30 years of doing this. At the same time, I am seeing some bank conventional competition, again, down here in the owner-user world, that'll fix some 10-year stuff in that 4 kind of range. So rate-wise, it's great. I think it's more a matter of the appetite now and who's actually pushing loans and who's not, as opposed to, and of course, those areas, hotels, restaurants that a lot of people are taking a second look at.
Well, let's address that current loan in progress right now. So if I was mid-March and I term sheet from a lender, or I was talking terms, have you had some deals blow up? If so, what did they look like? And have you had some deals come through to close? What did those look like? Jim, you're nodding your head. You get to go first.
Alrighty. Yeah, both. Had some deals that we had approved. We're moving along. Buyers got a little bit of cold feet, I think in a couple cases for the right reasons. It was retail. They were going to their 3rd location. It was stretching them a bit on the cash flow, but the kind of stuff that SBA can get done, especially people like us at Seacoast. And they have put it on hold. Unfortunate in one sense, because you may have heard, may not have heard, the SBA is actually making your first 6-month payments for you. However, that was not quite enough to get them over the hump. They went back to try and renegotiate and get some more time. Seller kind of had gotten to their limit on that, on the land. So put that one on hold. At the same time, we had several restaurant and hotel deals that we had approved that we went ahead and closed or are in the process of closing. We didn't pull any of our commitment letters. We are not doing new ones without really deep pockets at the moment for those 2 categories. But we honored everything we had done before. Obviously, they got in at a better rate and they got 6 months worth of payments. So they were very happy. But yeah, a little bit of both, a little bit on the buyer side and certainly some on the lender side.
Greg, any deals blow up or get closed?
Well, we've got, I'd say, a little bit of everything in our pipeline, as I imagine Dave does as well. I guess I'll kind of revert back to the same silos that I identified earlier. And, the deals that we had with banks, didn't fundamentally change other than, the banks, interpreted their loan documents, to the letter of the law, if you will. And what I mean by that is the banks are underwriting actual cash flows. So if you all of a sudden have tenants that aren't paying rent, and then that income obviously can't get underwritten, and then your loan becomes subject to lower cash flows. And if that triggers a change, then it triggers a change, and it shouldn't be viewed as a retrade. It should just be viewed as this is the new normal. With the life insurance companies, much as the case was with Jim, no changes, period. Life companies, that's one of the joys of doing business with them. If you're signed up with them, then they don't change deals. With the agencies, we've had a couple of deals adversely affected through this, primarily through the placement of debt service coverage reserves for some of the properties we have with higher leverage on them. And in those cases, the borrowers are being required to come to the table with sometimes up to 12 months of debt service payment reserves day one. That's a lot of money when you start talking about maybe an $8 or $10 million loan. I guess that's really kind of it, Dave. I don't know if you have anything you want to add to that.
Nationally, we saw in our pipeline from our 27 offices that there were a couple of deals that were done with debt funds. And what happened is that they use leverage to leverage the cash that they have on hand, their equity in their company. And so what happened is they ended up in the 11th hour, some of them pulling their commitments. So these are debt funds that are doing deals out on the fringe of real estate and on the fringe of leverage and deals that would normally get done by a local bank or a life insurance company. And so what happened is a few of those deals fell apart across the country. You mentioned Fannie and Freddie. Luckily, the first quarter, I got done a student housing deal in Michigan, and I did an op zone sale and an assumption of a bank construction loan. So those all happened up and through about the 12th of March. So I don't know what have happened to those transactions. I think they still would have all been done. The student housing deal was done with a life insurance company. So they've been really good about performing as agreed to. But going forward, I think we still have some challenges, and it's going to really play out as we go along and see how collections go, not only on the rent side, but on the mortgage side. And every borrower, every tenant, it's going to be, there can't be a cookie cutter solution from the borrower to the lender and back and forth, and between the borrower and the tenant.
And I think you touched on it earlier, Dave. I think appraisals are going to be a big question mark too. I think they're already trying to figure out how much discount do they need to work into there to be conservative, and what do the lenders want to see to protect them. I think that's going to be a big issue for us. We're more of an LTV cash flow kind of lender.
What I'm hearing in addition to that is that investment sales have almost come to a grinding halt just because there's questions about what's the capital available for that. I have an investor that can write a check, so he's gotten in the middle of a acquisition of industrial, a great asset class. It's going to be a value add, but they're going to put 50, 60% cash down and then borrow money for good, good news, tenant improvement, leasing commissions going forward. So that's in a transaction where a bank would say, with that much cash and only funding good news, yeah, that's something that I would take a look at.
Hey guys, gentlemen, I'm going to jump in real quick and address the audience. We are about 3 of 5 bars on our connection. We have our own dedicated server with Webinar Jam. It's important to us to have video in with these things. I miss seeing people's faces, and I know most of you feel the same way. So we may have some glitches as you go. Don't forget about that reconnect button. So if you don't have sound, if you don't have video, if something glitches, punch that reconnect button. You should get right back in. All else fails, make sure you're on Google Chrome, works the best. And then also, you can just reset your browser or go back into the original link we sent. So apologies for any sound issues. One thing we did miss, somebody said we cut out on bank interest rates. So was it, I don't remember if it was Dave or Greg that addressed bank interest rates?
That was me. And, what I've been hearing from my banking contacts is that, it's business as usual to a degree with the banks. Pricing has been kind of generally between 250 and 400 over LIBOR, with LIBOR floors varying from lender between 75 basis points and 100 basis points. Now, I will say with the traditional banks, though, that what you need to understand is that the banks are giving their existing depositor clients priority over everyone else, which shouldn't come as any big surprise. And also, if it is a new relationship with the bank, you can expect for that borrower to be, vigorously underwritten.
Thanks for that. Well, all right. So we got through deals in process. What if I'm actually sitting okay right now and I'm a developer or an investment owner and I've got some cash? Is now a good time to refinance? Should I be ringing your phones right now? And Jim, I know for you, you've got some interesting stuff. So go ahead. Was that Dave?
Yeah, I was just going to say it's never too early to start. And so the only time I'm trying to coach up prospects and clients, I would say, let us underwrite it. We do this every day. And let us crunch numbers for you and give you the sizing. I say that easily because I have analysts that do that for me. So you let us crunch and run with you if you're looking at an acquisition or you're looking at a refinancing, even if it's 6 months out. And that will give you a sizing idea of how the world looks at your deal today. And then you can always run later. And all it takes is updating it with some current financials, and boom, we got a package, we can go. But if you wait until you're ready, then it's a scramble. And I just think more time on your side. And as the market is fluid, lenders are going to come and go and sit on the sidelines. It's going to give you a feel for what's available. And as we tell you what could be coming, you might want to wait. So, hey, let's wait for these. You know, we survey 27, 30 life companies practically every day. And we have a running list of who's in, who's out, what their rates are and how they're pricing over compared to corporates. As things gel and as we get a better feel for how this is going to play out, you're going to have more options. But I always recommend, let's start now. Why wait?
I like it. All right, Jim, 10 minutes, you told me you could do this in, but jump in and tell us what the unique opportunities are for our small owner-occupieds and our small businesses.
Yeah, probably everybody's heard about the PPP loan program. So if you do have payroll, and I think you're under the 500 employees, and you haven't taken advantage of that, talk to your bank. And if they can't do it, reach out to somebody like me who is doing them or has a source to get those done. That's money that can be forgiven if you use it for payroll, rent / mortgage interest, and utilities. And that can go up to 10 million. We're a small bank, so we do ours up to 2 million. We're about halfway through our existing clientele, which obviously almost all of them qualify because they're all SBA clients. And although the money has technically run out today, it's already in Congress to restock that money. And I don't see politically how they're not going to be able to do that in the next few days. On the flip side, on the lending side, in addition to that PPP loan, the CARES Loan Act, which is what provided that $2.3 billion in funding, includes 6 months payments for all SBA loans. That existing SBA loans in good standing, automatic for all of my clients, no payments for the next 6 months. And it's not a deferral, but actual payments made for them. But it also includes new loans that are closed between now and about the middle of September. So we're seeing a ton of refinances, both from the standpoint of taking advantage of that. Maybe folks who are worried about the fact that they probably have a balloon coming up if they're on a conventional basis at some time in the next couple of years.
Hey, Jim,
Yep.
Can I stop you for a second?
Absolutely.
You talked right past, I think, a really important point. So
Sure.
our company is an SBA borrower,
Right.
and we're expanding, or we've been expanding across the nation. That costs money. That was probably the coolest thing I've ever heard of when our banker called and said the SBA is going to make our next 6 months payments.
Yeah.
And we don't have to repay it. They're paying the principal and interest. That really helped our income statement and our next 6 months outlook. Don't forget about that. But you said also for new loans.
Yeah.
So go back into that. If you have a balloon, and you can still take advantage of this.
Sure. As long as you're coming from a conventional loan and you obviously own the real estate, we can refinance. You can even add monies as long as it's going to benefit the business, any of the eligible purposes, which is improvements to the property, equipment, inventory, working capital. And your first 6 months payments will be made for you by the SBA, and it's actual payments made. It's not a deferral. It's not a repayment. It's not a kick them to the end kind of thing, which is amazing. That was a real benefit. And so where we're showing any slowness in new projects or projects that are being put on hold, we're actually seeing a real boon for refinances. And now's a great time. So not only you got rates in the 4 to 5% range with us, but your first 6 payments are made. So in effect, you're going to be less than half of that because it's payment principal as well as interest. So it's a great time from that standpoint, especially if you have a balloon coming up at any time in the near future and you're kind of concerned about what's all this going to do to my appraisal value, what's this going to do to my bank's appetite to renew this thing. Put it to bed one time now and take advantage of those 6 month payments. So those are the two big things that came out of there. Of course, the SBA also has their disaster loans. That's a program that you access directly from the SBA. So it's not necessarily as attractive because, dealing with the SBA directly, which we don't even do for our loans, is like any other government agency. It's a little bit slower than you'd like it to be and a little less maybe direct communication than you'd like it to be. But it is money that can be had at a very low interest rate for those who qualify, who technically can show an economic disaster or economic impact from the coronavirus regulations that have come out in terms of shutting their banks down or shutting their businesses down.
We got a question here that's relevant from David Dunn. Thanks, David. Should we apply to numerous banks for the PPP?
Technically, no. However, there's nothing wrong with applying for more than one. You can only have one loan. So the minute you know that any lender is close to sending you out actual documentation, you need to cancel the rest. And here's the reason. The PPP loan is really liberal in terms of normal borrowings. No collateral, no personal guarantees. However, in order to speed it up, some of the things that banks used to have to document on behalf of the SBA now are being done by certification of the borrower. So if the borrower gets into more than one loan, even by mistake, it's not going to look good for them. And you really don't want to mess with the government holding your stuff up. And even so the risk is on the borrower. So you got to be extra careful that you're not doing anything that's going to look untoward. But I'd apply with maybe two. Go to your own bank first because they have an incentive to work to get their clients done right away. But the minute you know one of them is clearly moving forward, I would withdraw the other one just so there's no possibility that your EIN number gets to the SBA twice, because that could really be a red flag for you.
I've got another question from Sarah Teal. If anybody wants to jump in on this one, why are the OpZone deals still getting done? I saw a big article that one closed. Are they things that people are looking to lend on?
I don't know what your take on this, Dave, is, or Jim, but I've yet to see any lender that I deal with on a regular basis give any sort of underwriting value to an opportunity zone. The lenders just don't care. It doesn't apply to them.
I'd agree to that.
I'm on my fourth one, and it's only because the first one was my sale where they ended up, it was a $40 million sale, and they raised $20 million. And the raise was done in 2019. So the value of doing an OpZone deal was very valuable for these investors to defer their gain till end of 2026, have a reduced basis, and then in the investment into this apartment transaction, any gain on that will be tax-free if they hold it a minimum of 10 years. The other three deals I'm working on are construction perm deals for apartments. And one investor had capital gains from the sale of family business, and he's fully funded in himself, so it's not being raised from third-party investors. The third one is in St. Paul, and that one is a group of guys who all have capital gains that they're putting in. Again, they're not going out to multiple other investors outside of their club. And then the fourth one is going to be in Milwaukee. That's going to be a raise from a wealth group. The issue there, I think that one's going to stall out, and mainly because mergers and acquisitions have stalled, so companies aren't getting sold. So the baby boomers aren't getting their capital gains there. I don't know if there's much left in capital gains if you sell a stock today. If you were thinking you had gains going through 2019 and going into January and February. And so I think that next raise for OpZones are going to be tougher. Greg is right. Lenders are not giving you any preferential, but I think because of the OpZone raises, the ones that I've done so far, the cash in is more like 35%. In one case, it was as much as 40% cash down. And that makes it easier for a construction lender to say, okay, I'm not doing an 82% loan to cost. I'm doing a 65% loan to cost.
That's good advice. We've got Jim, I don't know if you can see this from Brenda. If a user paid cash for a building last month and decides to get a loan on the same building to take advantage of the 6 months paid P&I, is that a reality?
It is a reality. We have to do in the SBA world, which of course is what allows for these 6 months, is we have to show that the use of proceeds, in other words, the loan funding, is an eligible use. So as long as that becomes an eligible use, yes. Now, historically, you could not take cash back out, even if you paid cash and wanted to do it the next day. but that has loosened up a little bit. So I would say if it's less than a month or even a couple months, it's possible we can still do the financing. But again, we have to be careful that the use of proceeds, it becomes an eligible purpose. So anything that's going to stay in the business or benefit the business, absolutely.
So you're not going to get to pull cash out necessarily, but you do get that 6 months thing that could be pretty
right. And then, like I said, the cash out part, it has loosened up a little bit. So I need to find out today if there's room to do it on a 30-day, 40 or 60-day, 90-day look back. For a while, they were letting us do that under some circumstances. I'd want to double check for you, but yes, otherwise you can do it definitely.
And a couple quick ones here from, I'm going to maybe butcher this, but it says Dean, D-E-N-E. I'm going to hope that's how you pronounce it. Dean wanted a copy of Dave's protocol for working with lenders. And Dean, Dave, are you okay sharing your slides?
Oh yeah, and then I'm sure that we could probably get our servicing department to also put together like the master list.
Oh, that would be fantastic.
I'll make a note here of that.
So when Dave gets that out, everyone that's registered will send you an email. Alan, if you're listening, don't forget to do that. And then the other question from Dean, with all the money exhausted from the PPP plan, I believe you addressed this, Jim, but hit it again. Do we think it's going to be refunded funded again by Congress? Yeah,
almost certainly. I mean, I don't see even the most political of them can withstand the heat now that it's actually run out. The base of the folks, I guess the Republicans and all have already approved another $250 million, but they're kind of waiting on the Democrats. We're trying to add a few things to it, good, bad, or otherwise.
No,
to speak of, but I don't think they're going to be able to weather the storm now that the actual money has run out. Now you're going to have all kinds of borrowers, bankers, taxpayers who are going to be screaming. And so it'll get done. It's just going to take a few days for them to play their politics and try and have something to say that they won on.
All right. I asked this question of all the panels I've been doing, and I'm going to put you guys on the spot, and everybody every time says, I don't want to be the first one to answer, but I think it's important to continue to track this for borrowers, for tenants, for landlords. What does this sort of recession thing look like? Are we going to bounce back in a V? Are we going to have a U shape? Are we going to have a Nike swoosh where it takes a long time, or perhaps bounce along the bottom for a while? Who wants to jump in and tackle that one?
I've learned not to go first.
I'll go. I'll step out there.
Thank you, Greg.
I think it's going to be a V. I think fundamentally, the U.S. economy was in such unbelievably good shape, going into March, and I think that if we can, restart the economy in the next, call it 45 days, then we're going to prove how resilient we really are. If it goes longer than that, then I may not be so bullish on it being a V. Maybe it's more of a bathtub. I don't know, but I think that if the entire recovery hinges on timing, if we can get out of this fast, we'll get back to where we were so fast you won't believe it.
Anybody else, Jim?
Yeah, then actually, Greg brought this up right before the call. We were just kind of wasting some time talking about economy. In Texas, I think we're looking for things to bounce back quickly, and that's the feeling I'm getting from my clients, which I've got about 75% of my clientele is here in Texas. I do deals all over the country, but we have people in other parts of the country that take the lead on those. But oil and gas, there's been some movement there, some pressures from, I guess, the president and other folks to get that price back somewhere where it is reasonable for our domestic folks to keep producing. That's probably going to be a bigger key for us down here is how does, where does that stabilize out at? Right now at $20, $30 a barrel, obviously that's not working for us. But if they can get that back around $50 a barrel, I think it still keeps our filling up our tanks at a reasonable price, and Texas will bounce back great. That's probably the one, other than timing, that's probably the one out there that could hurt us down here.
Got a good question from William here. Is it reasonable to expect parts of the nation to begin reopening sooner? I'll answer. I have to do a lot of research to get ready for these webinars and to I'm part-time. The rest of the time, I'm the CFO of our company. So I've had to read a lot of articles of people that I disagree with on how to do this. And I can tell you the answers are across the board. Every person seems to have an opinion on how the reopening is supposed to work. But from what I understand is on a national basis, they're tracking this virus on a county by county basis. And that's, I think, how they plan to attack the next however many months until we have a vaccine, that they want to be able to shut down localities and not shut down entire states or entire parts of the nation. Would you guys agree with that analysis?
I think that makes a lot of sense. I think you can't, apply a system to New York and then turn right back around and try and apply the same system to Fredericksburg, Texas. You can't lump everybody in there. And so breaking it out by counties makes a lot of sense, and that's something that's easy to understand. I think the one of the keys to successfully getting through this is to come out with a plan that is easy to understand and can command order, if you will.
Okay, so now let's apply that to lending. What are the lenders thinking on this reopening? Have you talked to anybody that's been talking about it in terms of closing deals and where the location of the real estate is?
I would say that lenders are evaluating their entire portfolio, and they've been asked, especially the banks, have to go through and mark to market all their retail loans and all their hospitality loans. And that's making them think through what their exposure is and what kind of risks they want to take going forward. So that is going to help shape lending as we go forward. In Minnesota, we pay our real estate taxes twice a year, in May and October. So May 15th is our next critical date. Well, May 1st is our next critical date in general, just to see who's paying rent and who's going to make their next mortgage payment. Then the next critical date is May 15th here in Minnesota, to see who pays their real estate taxes, because that is a default event. If you don't pay your real estate taxes, that now becomes a lien ahead of a mortgage. And so now lenders are going to have to start being proactive and start saying, well, Jesus, I don't want that piece of real estate back. How are we going to correct this issue? So there's some things coming that's going to start moving this along a lot quicker. The next round of payments that are due in 15 days and 30 days, what happens in Minnesota, what happens with our real estate tax payments?
So I would agree with that. I would say it's more asset specific than it is geographically specific.
Yeah, exactly. I was going to agree 100% with it's more the product and the industry for us. And again, same thing Dave was talking about. I mean, we're tied to the banks. We are a bank, so we're going to get what the Fed tells us as well as the SBA in terms of how we have to account for these hospitality type, restaurant type loans. If they'll give us some breaks on it, we'll keep doing them. If they're going to, cause it to be an unproductive, unprofitable asset, then we'll hold off for a while.
All right. Well, let's jump into a little more nitty gritty. Have you had a client call you and say, my tenants want to renegotiate? And then what advice are you giving that client, that borrower? Uh-oh.
It's just temporary.
I'll jump into that one first as well. I'm sorry, Dave, go ahead if you're ready. Okay. For some reason, I'm not hearing Dave, but I think that
That's why.
A couple of my borrowers, and the advice that I'm giving them is, whatever deals you cut with your tenants, you need to have those negotiations be private. It's nobody's business but yours and the tenants. And my advice to my borrowers is don't give up anything for free. I mean, don't just because you're their landlord doesn't make you their equity partner, and don't get pulled into Don't make their problem your problem. If they need rental relief, then you need to give it to them. But if you're going to give it to them, if it's a retail center, if I were a landlord, I'd say, okay, I'll give you the rental relief, but I want this co-tenancy provision in your lease to go away, or I want, I don't want the default provisions in your lease that say that if I'm not X percent, occupied, then you have to, you get to pay abated rent. I think you should apply a common sense approach to it. I don't know if that makes any sense, but that's the way I've advised my clients.
Dave, you back? You want to jump on that?
No, this is the international sign for we're having a tornado siren test.
Oh, I didn't know that was an international sign, but at least an air raid siren. I think about that often when I think about lately what we're going through now and what people went through the last, during the world wars and all those other things. And I feel a little bit thankful that a virus isn't the same as an air raid siren. So, Jim, you want to jump in? If you had any of your customers call and say, I'm having issues paying?
Well, we assumed ours is less tenant than it is because it's owner user, but we assumed a lot of our businesses were going to be hurting. So we immediately offered 3 months of deferrals on the payments before the 6-month SBA payments came out. So our guys are in good shape for the next 6 months, at least, with the automatic payments being made. But what I would say to even their clients is if you have a tenant and they're under 500 employees, make sure they're getting their part of the PPP program, because part of that is to pay rent. It's on purpose designed that way so that the landlords don't take such a beating, because there's not a way to hasn't been anyway politically a way to get money directly to the landlords yet. So, don't let them off the hook too easy before they've at least exhausted what's right there in front of them.
Yeah.
Well, go ahead, Greg.
On what I said earlier, I just, the point I want to make is, if your tenants need help, then, you should be, a good landlord and give them the help that they need. The last thing you want to do as a landlord is be stigmatized as, being, inflexible to deal with people that need help.
Yeah, to go back to what Jim said, it's rare that we get to sit back and say something was brilliant by the government, but to make sure that people are staying on payrolls and keep their health benefits and don't have to overwhelm the unemployment system was a brilliant move for the PPP. And then also to make sure that landlords are getting paid from the tenant is brilliant, because it's not going to cause as many defaults. But William here asked a really good question, and Greg, I think you can address this. The banks have a big brother in the Fed and somewhat of a backstop that can at least make life easier. The life companies do not. Is the federal government going to help the life companies with their losses, or are there any kind of bailout provisions for those folks?
That's a great question. And, even though the life companies aren't governed by the Fed, the life companies do have some governance, and it will come in the form of regulators, namely the NAIC. And as far as specific bailout goes, no, I haven't heard of the life insurance companies being the beneficiary of any bailout money. Now, where they are going to benefit is in a fresh look at how risk-based capital is viewed, and the reserves that are required on it. And so, now I have heard of the CMBS lenders, benefiting to the degree that they've reopened the TALF window from back in 2008 and 2009. But as far as the life insurance companies go, I'm unaware of it.
All right, we have got 7 or 8 minutes left.
Do you agree with that or no?
I'm sorry?
I would say, Dave, would you agree with that or no?
The international sign's down now because our siren's literally just finished. Unbelievable. It must have gone for 4 minutes. Jesus. Yeah, life companies, they're well suited. They've been very conservative on their underwriting. I think after going through 2007 and 8, they really structured their loan finances, their leverage and everything. They cranked it down, and they've been more conservative. So they can weather the storm here. But again, we're just in challenging times and unknown times. It's just something that we can't define at this point. I'm sure it's just like when it was for 9/11. We didn't know exactly what was going to happen, and they stopped the stock market for days and no flights. Remember how quiet it was in the skies. I'll just give you a couple quick short stories I got from a client today. He was a little more doom and gloom than I am, but from his perspective, and I'll end each one of these with, I think it's only temporary. So he has a warehouse space for one of the largest exhibitors in the country. They normally have 90 people at the warehouse. They now have 2. He says there's no conventions. They're all canceled for the rest of the year. He doesn't think there's going to be big ones in Vegas anymore, that they're all going to go to convention sizes of 200 to 500 people at most. I think that might be a little bit overreaction, but this is one guy's take. We just heard of a law firm in downtown Minneapolis, a big one, that their business is just booming. They're busting at the seams, but they're worried about how they're going to get paid. So what they're doing to keep all the employees on staff is they're cutting everyone's pay 20% to keep some dry powder so they can ride through collections. Again, I think that's temporary. The next thing he goes, childcare. He's got a client that owns 80 childcare across the country. Their occupancy is down to 20%. So they're not paying their rent, and that's when we start getting into talking to discussions. It's a net lease deal. They owe real estate taxes May 15th, so he's concerned about that. Again, I think this is probably temporary because our kids aren't going to go away, and the need for services when people go back to work. It's just going to be how are we going to handle children in daycare and what's going to be our distance and washing hands and handling that. And then he also mentioned that he has a space that he rents to a large company, a Fortune 500 company that makes these little sticky notes. Didn't really want to say what the name of the company was, but he said they're shutting down production lines of that sticky note because 2 out of the 3 lines because no one's buying office supplies. Again, I think that's temporary. So while we're stocking up and hoarding TP and canned soup, I think everyone should be stockpiling cash. This is going to go a little bit longer, but again, I think in the long run, it's going to be temporary.
That's great advice. A couple minutes left here. Does anybody else have parting words they want to share? Something we want to get in?
You know, the only thing that I'll say is that I've unfortunately been engaged in conversation no less than 5 times in the last 45 days that there's a liquidity crisis in the marketplace, and I'm here to tell you that is not the case. If you want a loan, you can get one. Underwriting has changed a little bit, and obviously, if you've got an oil and gas, heavy office building in the energy corridor, that's going to be a tough assignment. If you've got a hospitality property, that's going to be a tough assignment. But at the end of the day, for someone to insinuate that there's not money out there, that's just not the case.
And leveraging on that, because there is money, and that's the truth. We were looking for deals, and we're probably as busy as we've ever been. If the demand's not there, money's slowly but surely going to get easier, and the pricing's going to go down. So I think it's a great time to look at your situation and reach out, especially those who are more of been holding back because pricing's got them a little out of whack in property types and property locations. And now might be a great time to revisit that. Yeah.
And the other thing that I'll add, and Dave, I certainly want to give you a chance to jump in as well. But the other thing that I'll add is that, the life insurance companies and the agencies and the CMBS market and the banks, they're now, neck deep into dealing with the rigors of servicing through a pandemic. And these major capital sources are spread pretty thin. So the other advice that I'll give to borrowers out there is be patient and be prepared. The reality is that it's just going to take longer to make a market these days, and so just be patient.
And that's kind of going back to my slides when I start talking about our meetings at the MBA in February. They're sitting on a ton of cash. They're ready for real estate loans. The dam is going to break. Eventually, at some point this summer, they're going to be sitting there looking at, we're sitting on this cash, we're earning nothing. And we have to start making reasonable, well underwritten commercial mortgages to get this money out the door. And that's coming. And we just have, and that's why I suggest start some underwriting now. Let's talk about your options. Let's see what it shakes out right now, and put your plans together so that when things come, you're ready.
That's great advice. I want to take a moment before we sign off to thank our sponsors and to thank everybody watching. If you're in Texas and you're not familiar yet, Red News joined a larger group, RE Journals. We were scheduled to do 104 events this year, and which means 2 a week. And I'm used to, and our whole staff is used to getting out and seeing everybody, and we miss you dearly, and we know that you all do too. We'll get back at live events as soon as we can. I'm sure it's going to involve some social distancing. But in the meantime, we're going to continue to provide as many webinars as we can. We can't do that without sponsorships and without good speakers. So very much thank you to Seacoast Commerce Bank and Grandbridge for helping us put this on. And if you have any ideas for future events, please share them with us. You'll have my email address in your email inbox from the invite for this event. And we will send out Dave's slides. We will get the YouTube video up. Any other questions, send them my way. Guys, thank you very much. Gentlemen, thank you very much. Last chance to say your goodbyes, and then we'll sign off.
Thanks for having me. It was great.
Take care.
Yeah, and thank you again for the opportunity to share and learn. Thank you.
Great. Wonderful. I'm going to leave this up in case anybody wants to add any more questions. Leave it up for a couple minutes. If questions get asked in the chat room now, I'll pass them along to our speakers. Thank you. Have a wonderful afternoon.